Hello and welcome to this video. In this video, we are going to learn about investment appraisal and its various techniques. You see, investment appraisal is a process of evaluating the profitability of any investment in a particular project. The project may be introduction of a new product or any promotional campaign which has been taken up by the business, or relocation of the factory, or acquiring any non-current assets like plant and machinery. Before understanding various techniques of investment appraisal, let us first understand a very important principle, which is the time value of money. This principle is the main reason why we classify the investment appraisal. So what is this time value of money? It is a financial principle which states that the money which we have today has more worth than the same amount of money if we get it in future, or a dollar today is worth more than the value of a dollar in future. Why? Because there are various reasons. First, there is risk and uncertainty. There is a very important saying which says that a bird in hand is worth two in the bush. That is, if we try to catch the birds in the bush, there are chances that we may also lose the bird which is in hand, and the birds in the bush may fly away. In the same way, a firm can forecast future cash inflows and outflows. However, the prediction of future may or may not be as they have expected, hence it involves risk and uncertainty. Furthermore, because of inflation, a dollar today will have a greater purchasing value than a dollar after a year. For example, if we say we are able to purchase a coffee for $2 today, and the same coffee may charge us $2.50 after a year. So this shows that we are not able to buy the same cup of coffee for $2 after a year. Hence, the purchasing power of the money is more today when compared to the same $2 in future. So, because of this, a dollar worth today is more than a dollar in future. Furthermore, business can profitably invest the money today and earn a higher value of returns in future. For example, if a firm can invest $100 and get a return of 10% per annum, so after a year they can get $110 for the same $100 which they have invested today. So based on this, we can say that a dollar today is worth more than the dollar in future. Now when we talk about the techniques of investment appraisal, they are traditional or non-discounting techniques which do not consider time value of money, and in this we have the payback period and accounting rate of return, which is ARR, and then we have the time adjusted or discounted cash flow techniques which take into consideration the principle of time value of money, and in this we have net present value, which is NPV, and internal rate of return, which is IRR. Now let's understand about the payback period. You see, payback period is a technique in which we try to find out the time period in which we can get our initial investment back. You see, some projects may have a very long payback period. Why? Because here the cash receipts are very slow and it may take a very long time to get our initial investment back. Whereas some other projects may have an average payback period where we can have an average cash receipts. However, when we go for the payback period, we try to find out the projects in which we have the fastest recovery of our initial investment, and these projects are selected based on the payback period where we have the smallest payback period. Now let's understand the steps which are required to calculate the payback period. We have 3 steps. In step 1, we find the net cash flows. How do we get this? We take the cash inflows, from there we subtract the cash outflows, we get the net cash flows. And in step 2, we find the cumulative net cash flow, from there we find the year in which we are going to get our initial investment back. And in step 3, we calculate the portion of the year that will be needed to achieve the payback. You see, we may not require a whole year to get some of the investment back. Like, for example, in a project, we are able to get in 2 years 80,000 and our initial investment was $90,000. So for the amount of $10,000 we may not require a complete year, we may require a portion of year, and this can be calculated in terms of months or days of the year which have been required to get our initial investment back. So this is how we are going to find the payback period. Now let's understand the payback period with the help of an example. We have an example here where M Limited is planning to buy a machine costing $100,000, and we have years cash inflows and cash outflows given. In year 1 the cash inflow is $80,000 and cash outflow was $40,000. In year 2 the cash inflow was $90,000 and cash outflow was $50,000. In year 3 the cash inflow was $100,000 and the outflow was $60,000. In year 4 the cash inflow was $80,000 and the cash outflow was $50,000. We are asked to calculate the payback period for the machine. So let's start the solution with the step 1, where we will calculate the net cash flows. And how do we get this? We take the cash inflows, from there we subtract the cash outflows. So the initial year we have a initial investment which is an outflow of $100,000, hence it is a negative $100,000, and our net cash flows will be negative $100,000. Then in year 1 we have the cash inflows of $80,000 and the outflows of $40,000. So from 80,000 if we subtract 40,000 we get the net cash flows as $40,000. Then in year 2 we have the inflows of $90,000 and the outflows of $50,000, so we get the net cash flows as $40,000. Then in year 3 we have the inflows of $100,000 and the outflows of $60,000. We'll get the net cash flows as $40,000. And in year 4 we have the inflows of $80,000 and the outflow which we will subtract will be $50,000, and hence we get the net cash flow as $30,000. Next, in step 2 we will find the cumulative cash flow. In the year 0 we have an outflow of $100,000 which is a negative $100,000. Then in year 1 we have the net cash flows of $40,000. So minus $100,000 plus $40,000 will get the value as minus $60,000. Then in year 2 we have minus $60,000 plus $40,000, we get the value as minus $20,000. Then in year 3 we have minus $20,000 plus $40,000, we get the cumulative cash flow as $20,000. Then lastly it is $20,000 plus $30,000 which will be $50,000. Now from here we can see that we are able to recover our initial investment in year 2. We have the negative cash flow and some portion of year 3. So in the third step we will find the portion of year 3 which will also be required to complete the payback period of the investment. So now in step 3 you see in the year 3 we were able to get a net cash flow of $40,000, and this we were getting it in a whole year, that is in 12 months. So 40,000 we were able to get it in 12 months. So we require only this 20,000 to be recovered for the initial investment. So 20,000 how much? So when we cross multiply this we get 20,000 times 12 by 40,000 which will be equal to 6 months. And this can also be calculated in terms of days, that is 40,000 we are getting it in 365 days. 20,000 how much? So it will be 20,000 times 365 divided by 40,000 which will be 183 days. So the payback period will be 2 years 6 months or 2 years 183 days. So these are the 3 steps by which we calculate the payback period. Now let's discuss about the various rules to accept or reject a project based on the payback period. You see, we accept those projects where we have the smallest payback period. That is, if we see here, we have 2 projects. In first project, we have the payback period of 2.5 years. And in the second project, we have the payback period of 5 years. So the smallest payback period is 2.5 years, hence this project will be accepted. Furthermore, there can be a criteria of standard payback period, like a firm may have a criteria that the payback period should be 4 years, and all the projects below the 4 years can be accepted and above 4 years will be rejected. That is the payback period. If it is less than the standard payback period criteria, then we accept the project. If the payback period is greater than the standard payback period, we reject the project. And if the payback period is equal to the standard payback period, we may either accept or reject the project. So based on this, as we have here a standard payback period of 4 years, we will accept the project which is less than 4 years, that is 2.5 years. This project will be accepted, and the project where we have the payback period of 5 years will be rejected. Why? Because this is more than 4 years. So this is how we accept or reject the project based on payback period. Let's learn about the advantages of payback method. It is easy to calculate when compared to the other techniques of investment appraisal. Furthermore, we use the net cash flow to find the payback period and not the profit, as profit is subjective in nature and it depends on the company policy. And as we don't use profit when we calculate the payback period, we use the cash which is objective in nature. We get a more appropriate or accurate picture of our investment appraisal, and moreover, payback period highlights the timing and the size of the cash flow. So the projects in which we get the huge cash inflows in the initial years and which have the shortest payback period are less risky, and this can be used to compare different projects. Furthermore, short payback period results in increase in the liquidity and enables the business to grow more quickly. The two main disadvantages of payback period is it ignores the time value of money. That is, it do not take into consideration the present value of the future cash flows. Furthermore, it do not take into consideration the entire life of the project. Once the payback period have been evaluated, the net cash flows after that time are ignored. Like in our example, after 2.5 years, which is our payback period, rest of the cash flows are ignored. The next investment appraisal technique which we are going to learn will be the accounting rate of return or ARR. Accounting rate of return or ARR, in this we find the average profit and the average investment, and then we take the percentage of average capital invested. So this will be our accounting rate of return, and we have various steps for this. The first step is we calculate the expected profit over the life of the investment, and once we get this, we find the average annual profit. You see, average, we take the total divided by the number. In the same way, here we take the total profit over the life of the investment divided by the years of the life of the investment. Then we get the average annual profit. Next, we find the average investment. In average investment, we take two things into consideration, that is the initial cost plus the residual or the scrap value. However, according to your syllabus, it was mentioned that the questions will not involve residual value, that is, the total amount will be depreciated and we will have a zero scrap value or the residual value. So, as the residual value or the scrap value is 0, we take the average investment as initial cost and divide it by 2. So, now we know the average profit as well as the average investment. Now, we'll find the percentage or the ARR, and how we do this? We take the average profit divided by the average investment times 100%. So now we'll get the percentage rate, and this will be our ARR. Next, to understand ARR, we are going to take the same example which we have taken in the payback period. That is, M Limited is planning to buy a machine cost of $100,000. Estimated useful life of the machine is 4 years, after which the scrap value is nil. That is, there is no residual value. Then we have been given the years inflows and cash outflows same as what we got in the payback period. Then we are asked to calculate the ARR for the new machine. Furthermore, additional information is provided which states that M Limited currently earns a ROC, that is return on capital employed, of 15% and requires any new investment to earn at least the same percentage. So we'll start with the solution, in which we have the step 1 where we have to calculate the expected profit for the investment. If we have done the payback period, then we already have done the years cash inflows, cash outflows, and calculated the net cash flows. For expected profit, what we can do is we can total up the net cash flows and find the expected profit, and here we'll get the expected profit for the investment as $50,000. If we have not calculated the net cash flows, then we can do the other method as well, that is we take the total cash inflows, that is 80,000 plus 90,000 plus 100,000 plus 80,000, which will be $350,000, and from there we subtract the total cash outflows. What we have here is 40,000 plus 50,000 plus 60,000 plus 50,000, which will be $200,000. So from 350,000 we subtract the outflow of $200,000, plus we also subtract the initial investment. Why? Because it will be completely depreciated, so this will be the total depreciation and will have a scrap value of 0. So we are going to subtract the initial investment as our depreciation, which will be $100,000. So now we will get the expected profit over the life of investment as $50,000. So with this we have completed the step 1. Now in step 2 we find the average profit, and we have the formula, which is total profit over the life of investment divided by the life of the investment. The total profit which we got was $50,000 divided by the life of the investment, which is 4 years. We get the average profit as $12,500. Then in step 3 we find the average investment. As scrap value is 0, we will take the initial investment and divide it by 2. So it will be 100,000 divided by 2, which will be $50,000. Now we will find the percentage or ARR, that is we get the accounting rate of return will be equal to the average profit divided by the average investment times 100. So here our average profit which we got was 12,500 divided by the average investment which we got was 50,000 times 100. We will get the value as 25%. Then we have the decision rules for ARR. These are the rules on the basis of which we will accept the project or reject the project. That is, if the ARR, that is the accounting rate of return, is greater than the cost of capital, which will be our cutoff criteria, or the ROC, that is return or capital employed. If ARR is greater, then we will accept it. In this problem we have the ROC as 15% and ARR as 25%, so we will accept this project. But in case if ARR is less than the cost of capital or ROC, then we reject the project. And in the last scenario, if ARR is equal to the cost of capital or is equal to the return on capital employed, then we can either accept or reject the project. There are various advantages of ARR. The first one is it is simple and easy to calculate when compared to the discounting techniques, that is NPV and IRR, because in that we have to first find the rate of discount by taking the discount formula, and then we find the discounted cash flow. So it is a bit complicated when compared to ARR. And then the main focus for ARR is profit, and this is the primary objective of the company. Furthermore, it takes the total or the entire period of economic life of the project in estimation, whereas in payback period method we were just taking those cumulative cash flows till the time we received the initial cash flow, so it was not taking the entire life of the project into consideration. However, ARR is taking the entire life of the project into consideration, and hence it may give us a clear picture of the profitability from the project. Furthermore, it can be used to compare different projects. However, we have some disadvantages of ARR. The annual profit is subjective in nature, as I told you in the payback period method as well. That is, profit is subjective in nature because it changes based on the company policy. Furthermore, we do not take external factors like how good is the motivation of the workforce, how efficient is the workforce, and how the productivity can be increased, or how productive is the workforce, as well as how the project will affect the environment, and all the other non-financial factors are not considered, which may also affect the profitability of the business. However, when we are calculating the ARR, we are just taking the financial factor, that is the profit, and external factors are not regarded, which is a major flaw of ARR. Then we have the other problem, that is again ARR does not consider time value of money, same as payback period. Furthermore, in ARR we have an additional drawback, that is here we also ignore the timing of the cash flow. You see, as I told you, in the payback method, the quicker we get our cash inflows or our initial investment back, the project will be less risky, as this will help the business to have more liquidity available in the business, and this money which they have and they have recovered or got the payback as soon as they have invested, this can be used more profitably in other projects, and this is not considered when we have taken the investment appraisal technique by means of accounting rate of return. Next we have net present value, which is NPV, and this is a discounted cash flow technique where we consider the time value of money, and in NPV we calculate the discounted cash values of investment inflows. From there we subtract the discounted cash outflows and we get the net present value.
There are 3 steps to calculate net present value. In step 1, we calculate the net cash flow, same as the payback period, where we take the cash inflows. From there we subtract the cash outflows and we get the net cash flows for each year. Then in step 2, we find the discounted cash flow. This is done by multiplying the discounting factor with the net cash flows. Then in step 3, we calculate the net present value by adding up all the discounted cash flows. Now let's understand the NPV with the help of an example. It is the same example which we have used in the payback method as well as ARR. Here we have a company by name M Limited, and it is planning to buy a machine costing $100,000. Estimated useful life of the machine is 4 years and the scrap value is nil, and the company policy is to depreciate the non-current assets by using straight line method. We have the following information about the year cash inflow and cash outflow. Year 1, we have the cash inflow of $80,000 and outflow of $40,000. In year 2, we have the inflows of $90,000 and an outflow of $50,000. Then in year 3, we have the cash inflows of $100,000 and the cash outflows are $60,000. In year 4, we have the cash inflows of $80,000 and the cash outflows of $50,000.
However, we require the discounting factor for this. The further information which is given is M Limited cost of capital is 10%. The discounted factor for present value of 10% are in the year 0, that is the present value, and for present year we will have $1 worth as 1 itself, because for today $1 worth will be same as 1. So the discounting factor will be 1. For year 1 it is 0.909, for year 2 it is 0.826, for year 3 it is 0.751, and for year 4 it is 0.683. We are asked to calculate the net present value for the project. So we'll start with the step 1 where we will find the net cash flows. We'll do the same way as we have done in the payback period method, that is we take the cash inflows, from there we subtract the cash outflows. So in the year 0, that is in the initial year, there is an outflow of cash, which is the initial investment of $100,000. So this is negative $100,000 and the net cash flow will be negative $100,000. In year 1, the cash inflows was $80,000 and the outflow was $40,000. So 80,000 minus 40,000 will be 40,000 as our net cash flow. Then in year 2, the inflows are 90,000 and the outflows are 50,000. So our net cash flow will be $40,000. In year 3, the inflows are 100,000, the outflows are 60,000. So our net cash flow will be 40,000. And year 4, we have the inflows as 80,000, the outflows as 50,000. So the net cash flows will be $30,000. So with this we have done the first step. In step 2, we take the net cash flow and multiply it with the discounting factor. So we have been given the discounting factor at 10%. So in the initial year, we have an outflow of $100,000 and the discounting factor is 1. So our discounted cash flow will be negative $100,000. That is an outflow. Then in year 1, we have the net cash flows as $40,000 and the discounting factor which is given is 0.909. So when we multiply this together, we get the discounted cash flow as $36,360. In year 2, we have the net cash flows again as $40,000. The discounting factor at 10% was given as 0.826. So when we multiply this 2, we get the value as $33,040. And in year 3, we have the net cash flows again as $40,000, and when we multiply it with the discounting factor for year 3 is given as 0.751, we get the discounted cash flow as $30,040. In year 4, we have the net cash flow of $30,000. The discounted factor at 10% is 0.683. So when we multiply this, we get the value as $20,490. So that will be our second step. Now in the last step of our net present value, which is step 3, what we do is we total the discounted cash flow. So we have negative 100,000 plus 36,360 plus 33,040 plus 30,040 plus 20,490. When we total this up, we get the net present value as $19,930. Next, we have decision rules. If NPV is greater than 0, that is, we have the positive NPV, as in the case of our present example, we have positive NPV, so we accept the project. If we have NPV less than 0, that is, we have negative NPV, then we reject the project. If NPV is equal to 0, then we can either accept or reject the project. Then we have various advantages and disadvantages of net present value. The biggest advantage here is we take time value into consideration. Furthermore, we take the cash flows into consideration, hence it is less subjective. And apart from that, in NPV we take all the cash flows into consideration, unlike the payback method. Hence the suggestion which we get based on net present value will be more accurate. However, we have certain disadvantages, that is, NPV takes into account the estimated future cash flow, which may not be accurate because this estimation is based on the discounting factor, and if we don't get an appropriate discounting factor, then the estimation may have some errors.
Moreover, the managers may not fully understand the concept of present value, and it may be difficult for them to calculate the discounting factors. So these are the various disadvantages of net present value.
Next, we have internal rate of return, which is IRR. It shows the true return on the investment expressed as a percentage, and it is the cost of capital when the net present value is 0. For this, we have various steps. In step 1, we select two discounted rate, which is wide apart, so that we can get a positive NPV and a negative NPV. Then in step 2, we calculate the net present value for each of the two discounted rates chosen in the step 1. Then in step 3, we find the percentage at which the net present value is 0 by using the formula IRR is equals to capital P plus capital N minus capital P times small p divided by small p plus small n, where capital P is the rate which gives us the positive net present value, capital N is the rate at which we get the negative net present value, small p is the positive net present value, and small n is the negative net present value. For understanding this, we will use the same example which we have been using, where we know the cost of machine was $100,000. We know the inflows, we know the outflows. The additional information which we have is the discount factor at 20%, and for year 1 it is 0.833, for year 2 it is 0.694, for year 3 it is 0.579, and for year 4 it is 0.482. Then we have to calculate the internal rate of return for the project, and step 1, we have to select two discount rates. This will be given in the question. Here we have the discount rates as 10% and 20%. Then we will proceed and find the net present value. For 10% we have already calculated when we did the net present value in the previous slides. Now we'll find the net present value at 20%. So we'll take the years, cash inflows, cash outflows. When we subtract from inflows, outflows, we get the net cash flows. Then we will multiply it with the discounting factor of 20% and we'll get the discounted cash flows. So in year 0, the cash inflow is not there. We have a cash outflow of $100,000. So hence it is a negative 100,000 because it's an outflow. Then we get the net cash flow as negative 100,000, and the discounting factor in the initial year will be 1. So when we multiply this, we get the discounted cash flow in the year 0 as negative $100,000. In year 1, we have the inflows of 80,000, the outflows of 40,000. So when we subtract this, we get the net cash flows of $40,000. We multiply this with 0.833, we get the value as $33,320. Then in the year 2, we have the inflows of 90,000 and the outflows of 50,000. So the net cash flows will be $40,000. When we multiply it with the discounting factor of 0.694, we get the value as $27,760. Then in year 3, we have the inflows of 100,000 and the outflows of 60,000. So when we subtract this, we get the net cash flow of $40,000. We will multiply it with 0.579. We get the value as $23,160. Then in year 4, we have the inflows of $80,000 and the outflows of $50,000. When we subtract this, we get the net cash flow of $30,000. We'll multiply it with 0.482. We get the discounted cash flow as $14,460. So we have negative 100,000 plus 33,320 plus 27,760 plus 23,160 plus 14,460. We get the net present value as negative $1,300. So with this, we have completed the step 2. Now in step 3, we will apply it in the formula, which is IRR is equals to capital P plus capital N minus capital P times small p divided by small p plus n. Our capital P is 10%, our capital N is 20%, our small p is, we have calculated previously as $19,930, and the small n which we have calculated here is $1,300. Now we substitute it in the formula and we get the IRR as 19.39%. Then we have the decision rules to accept or reject IRR. For this, we take IRR if it is greater than the cost of capital or the return on capital, whatever is the cutoff criteria. Based on this, if it is greater, then we accept it. If IRR is less than the cutoff criteria, then we reject it. If IRR is equals to 0, then we can either accept or reject the project. Then we have various advantages and disadvantages of IRR. The advantages are it considers the time value of money, it uses the cash flow which is less subjective in nature, it uses all the cash flow unlike payback, and it provides the business with exact discounting cash flow rate of return that a project is expected to make, and this helps in comparison. The drawbacks or the disadvantages of IRR is it needs to consider different discount rates and it involves multiple calculation. It is time consuming as choosing the discount rate for the cost of capital is a matter of guesswork. However, for us, as they give us the two different discount rates in our question, it becomes easier, but in reality they have to guess the negative discount rate and keep on calculating, which will be time consuming, and it is also complicated to calculate and it will not be easily understood by the non-accountants. So these are the disadvantages of IRR. So with this, we have completed the concept of investment appraisal. Thanks for watching my videos and have a blessed life.